Hello guys, and welcome to another episode of my lecture. This is Olayeni Dieko Daniels, popularly known as Dieko Spectre, and welcome to another episode of Dieko Talks Law. On today's episode, we'll be talking about how to identify equitable interest in relation to equitable mortgage, where we'll talk about the part 2 of this lecture. In the part 1 of the lecture, we'll discuss how to create equitable mortgage in relation to two instances. The first instance is where you mortgage an equitable interest, and the second instance is where there is an agreement to create a legal mortgage. And then I was able to show the difference between the both of them. Today's episode, we'll be talking about the third instance in the creation of an equitable mortgage, where there has to be deposit of title deeds. But before we go into the substance of today, if this is the first time of joining my lecture, I want to say a very big welcome to you. Please make sure that you click the subscribe button and subscribe to my channel, and make sure that you click the notification bell so that anytime I release a video of this nature, you'll be one of the first set of people to watch the video. Also, make sure that you follow me on Instagram at Dieko_Daniels and on LinkedIn at Dieko Daniels. Lastly, I would like to shout out to two people who made this particular lecture possible. The first person being Komolafe Praise from University of Ilorin, who made sure that the lecture note for this lecture is made possible. And also the second person is Odunwale Emmanuel from University of Lagos, who made sure that the graphics in relation to this course is made possible. Thank you so much, guys. So now we go straight to what we are discussing today, which is equitable mortgage. So on today's class on equitable mortgage, we are talking about deposit of title deeds. And then the question is, how exactly does deposit of title deed create an equitable mortgage? And that is what we are talking about now. So if A borrows money from B and deposits with B the title deed of his, that's A's land, and does so with an intention of treating the land as security, an equitable mortgage will be created. Simple as ABC. So you have two elements here. Number one, you must have somebody who is in need of money. In short, you don't even need to be in need of money. You just need to collect money. So you want to collect money from somebody. And because you want to do that, you then carry your house, the title deeds to your house. That's the ownership of your house. You carry it. You go and drop it with another person. It could be a bank. It could be a friend. It could be anybody. Then you drop it with that person and tell the person, take the titles to my house and give me 50 million naira. Because you have not conformed with the provision of the law, which stipulates some other things, which include the fact that there must be a mortgage deed, that particular action of yours cannot be said to be a legal mortgage, but at best an equitable mortgage, because you have complied with the two requirements. Not only have you dropped your title deed with somebody, but that title deed must have been accompanied with an intention to keep that particular document with that person to be made as a security for the loan that you're about to collect for that person. There must be those two things proven before the court. Number one, there must be the fact that you must have dropped the title deed. That must be evidence before the court. And number two, there must also be evidence as to the intention that that particular title deed that has been dropped, with the person was done so to be used as a security for the loan to be advanced by that person. If those two evidence are placed before the court, then the court can infer that there has been an equitable mortgage. Do you understand that? Now, to continue with the note, this type of equitable mortgage is common in Nigeria, especially in relation to deposits with banks to secure overdrafts. It was addressed by Fatu Williams J, as it then was, in the case of British and French Bank Limited versus Akonde, that a deposit of the deeds alone, unaccompanied by a memorandum of the terms of deposit, does not in itself create a charge over the land, and that the mere possession of the deeds without evidence of the contract under which possession was obtained will not create an equitable security or equitable mortgage. Do you understand that? Let's go through that again and look at certain elements. Learned Justice Fatai Williams J, as it then was, said something very important to us. He said that number one, there must have been a deposit of title deeds. Now, he said deposit of title deeds alone accompanied by a memorandum of the terms of deposit, does not in itself create a charge over the land, and the mere possession of that deed, without evidence of the contract under which possession was obtained, will not create equitable security. Which means that if you go and deposit deed with somebody without any evidence to show, or you come to court and say, my lord, I have given him the title deed, and because the title deed I gave him, or my lord, because he gave me the title deed, my lord, it therefore means that there has been a mortgage. That my lord will tell you, no, my brother, go back to what my learned brother said. In the case of British and French Bank Limited versus Akonde, my learned brother said that for you to have an equitable mortgage through the third means, which is deposit of title deeds, you must not only deposit the title deed, there must have been a memorandum of some sort, a contract of some sort, evidencing that such deposit of title deed is with the intention that title deed is to be used as security for the loan. That's what Fatai Williams has said in the case of British and French Bank versus Akonde. Not only must you drop the title deed, you must drop the title deed with an evidence of some sort, which according to Fatai J should have been a memorandum of the terms of deposit, showing that deposit of the title deed was made so that title deed will be used as security for the loan. Do you understand that? But you say, oh no, you just go to deposit title deed, you don't expect memorandum, you don't expect any other evidence, but the fact that you have deposited title deed shows that, there is security. It does not work like that. It doesn't work like that in court, and that's what Fatai J has said. However, now it should be noted that if there is another parole or written evidence that the equitable mortgage would have been created despite the lack of memorandum, provided the parties intended that the deposit was by way of security. Now what we are saying here is this: where you don't have a memorandum, don't forget that what Fatai Williams said is that there must have been a form of memorandum in British and French Bank versus Akonde. There must have been a form of memorandum evidencing the terms of the deposit, telling us that the deposit of the title deed was to be made for the security of the loan. That is what Fatai Williams J is telling us. There must have been a form of memorandum. However, you should note that even if there is no form of memorandum, but still there is some form of evidence, either parole or written. Parole means oral, either oral evidence or written evidence. It could be an email. Let's say I went to drop my title deeds with a bank, then I told the bank during our email conversation, one of it I mentioned that it was supposed to be used as security. That will suffice. Or when I was talking to the receptionist or whoever attended to me, I said it was supposed to be used as a form of security. I told the person that the title deed should be used as a form of security, and I'm able to prove that before the court that yes, that title deed should be used as a form of security, and I said it, I made it clear when I went to the bank to deposit it. That also will suffice. Do you understand? It will suffice. But the only thing is, when it comes to parole evidence and all those kind of things, it's quite difficult to prove. Do you understand? But if there is a memorandum evidencing it, it makes it a little more easy. However, a memorandum evidencing it is not necessary, like the only necessary condition to proving it. No, it is a sufficient condition. You can prove it through a memorandum. However, it is not a necessary condition that if you have not proven it through a memorandum, you will not make it. Do you understand? Therefore, other sufficient conditions include any other form of written evidence, which could be email, text, or whatever could be proven before the court. Another could be parole evidence. Do you understand that? Where you have an oral evidence that you can tender before the court. And so when we are talking about this rule, it's still important for us to look at the fact of the case. Now, in this particular case, where the defendant had deposited the title deed of his property with the plaintiff bank to secure an overdraft without drawing a memorandum of deposit, the plaintiff's interest had been noted on insurance policy taken out by the defendant in respect of the property to which the deed was related. So you see that. So where the court can infer or could infer in this case is that there was a security. He was dropped at the bank, collateral, title deeds dropped at the bank to form security. But the fact that they dropped it, there was no evidence, through a memorandum to prove that collateral, dropped as a form of security was for security of the loan. Do you understand? But the court was able to infer because there was an insurance policy that was drawn. That insurance policy was drawn by who? By the defendant. The defendant took an insurance policy and then he noted the plaintiff's interest in relation to the title of the house. The insurance was taken in relation to the house, and then the defendant who took the insurance, that's the person who mortgaged his own property, he took the insurance and he noted in the insurance policy, he noted the interest of the plaintiff bank there, and he also noted that the title deed was a form of collateral in the insurance policy. So obviously you can infer that if that could be in a written form, where the defendant, while taking out the insurance policy, could say, yes, under this insurance policy, the title deed is not with me, the title deed is with the plaintiff, and the title deed is with the plaintiff because it's a form of security for particular loan, blah blah blah. That in itself, that policy was what the court used as a substitute for the memorandum, which is lacking, as a substitute to create an evidence before the court that yes, not only was there deposit of title deed, there was deposit of title deed with the intention that such deposit should be used as security for the loan. And that is the case of British and French Bank Limited versus Akonde, where we talk about the third way by which we can create equitable mortgage. Now, in my next class, we continue with other ways by which we can identify equitable interest. And my next class will be talking about equitable charge. Equitable charge. Thank you so much for watching to the end of this lecture. Please make sure that you like and subscribe to my channel, and also make sure you share these videos with your friends who are going to obviously need the video. And don't forget to follow me on LinkedIn at Dieko_Daniels and on Instagram at Dieko_Daniels. I will see you in my next class.